Hello and welcome to this episode of the Third Umpire. In the last 1 year, the benchmark Nifty has grown by about 5% only. And in the last 6 months, the Nifty has not really given any returns at all. Yes, the fixed deposits are looking a lot more lucrative if I were to look at this data point, especially at a time when the interest rates are soaring higher and higher thanks to our new best friend, the inflation. So, is this the end of the road for the Indian equities, or is this just the beginning? Should you be pulling it all out, or should you be going all in at a time when a global recession is expected to be anywhere around the corner? We will discuss that in the last section of today's episode. While we do that, we will also talk about how India has fared in its efforts towards climate change mitigation when compared with the rest of the world, especially the G20 countries, and also look at the advantages and the disadvantages of the extension of the trading hours at a time when NSE is mulling over the same. So stay tuned. You're watching Informed Investor, the Third Umpire, an initiative by Research and Ranking. Let's begin. Now, the world is facing a major challenge in the form of a climate change, which is causing catastrophic damage to both the environment and the economy. Now, with the planet getting hotter, the ice caps melting and the natural disasters becoming more and more frequent, we urgently need to take action to combat this threat. However, amidst all the doom and the gloom, there's a ray of hope. According to a recent study by the Observer Research Foundation, several countries are making impressive progress in mitigating the impact of climate change. But how can we measure the effectiveness of different countries in tackling this global crisis, you may ask? That's where the Climate Performance Index comes in. It is a tool that helps assess the performance of the G20 countries in mitigating climate change. Now, before we dive deeper into this exciting topic, let's first take a moment to understand what is G20 all about. The G20 is a powerful intergovernmental forum made up of 19 countries along with the European Union. Now, it is a powerhouse that tackles some of the world's most pressing issues, including climate change mitigation, sustainable development, and international financial stability. So why is the G20 so important when it comes to the climate change? Well, for starters, it brings together the world's most developed economies and emerging ones. Together, these countries account for more than 80% of the global GDP, 75% of international trade, 60% of the world's population. But that's the kicker. The G20 economies are also responsible for 75 to 80% of the global greenhouse gas emissions. That means that the G20 has a massive role to play in reducing global carbon emissions and mitigating the impact of climate change. So what's been happening at the G20 when it comes to climate change? At the Joint Environment and Climate Ministerial meeting held in August 2022, member countries acknowledged the severity of the climate crisis and pledged to prioritize 3 critical issues in fulfilling the goals set by the Paris Agreement. These include promoting a sustainable global economic recovery, taking land-based and ocean-based climate action, and mobilizing resources for environmental protection. Now, the report card to this is the Climate Performance Index. So going back to what is the Climate Performance Index? As I was saying, the Climate Performance Index is not just a ranking system, but it also serves as a tool for countries to learn from each other and improve their climate policies and actions. Now, it provides a detailed analysis of the climate performance of each country, highlighting their strengths and weaknesses and providing recommendations for improvement. For example, if a country scores poorly in a particular area such as renewable energy or energy efficiency, the Climate Performance Index report will suggest measures that can be taken to improve the situation. On the other hand, if a country scores well in a particular area, the report will highlight their best practices and policies that can be adopted by the other countries as well. Now, this collaborative approach to addressing climate change is essential for creating a sustainable future for all. Now, by learning from each other's successes and failures, countries can work together towards achieving common climate goals and the targets. And the Climate Performance Index is a valuable tool in this effort, providing actionable insights and recommendations for countries to improve their climate performance and create a better world for the future generations. So how does India fare in its efforts towards climate change mitigation? Surprisingly, India, often regarded as a land of diverse cultures and traditions, is now making headlines for our efforts towards climate change mitigation. For the good reasons, of course. According to the recent study by Observer Research Foundation, India is leading the pack amongst G20 countries alongside Italy in taking action to reduce carbon emissions and combat climate change. Now, the study has brought to light some key factors that have helped us to achieve this feat. First is significantly low per capita contributions to carbon and greenhouse gas emissions. This means that compared to other countries, the amount of pollution each person in India produces is much lower. Second is the very limited share in legacy emissions relative to its population needs. In other words, India has not contributed as much to historical accumulation of greenhouse gases in the atmosphere as other countries, even though it has a large population. Third is the least rate of per capita energy use. This means that the Indians use less energy per person compared to other countries. Now, despite being a developing country, India has managed to achieve this through various measures such as promoting renewable energy and energy efficiency. Fourth is the significant efforts towards not only preserving but also expanding its climate regulating land cover by 6% compared to its 1992 levels. Now, despite being a developing country, we've managed to make a significant commitment to reducing carbon emissions and to tackle climate change through various measures such as promoting renewable energy and energy efficiency. In fact, during the India Energy Week 2023, Prime Minister Shri Narendra Modi ji announced that India's energy demand is expected to double in the coming years, reaching 11% of the global demand, up from the current 5% levels. Now, this highlights India's growing role in the global climate action and the country's determination to lead the way towards a more sustainable future. While our efforts towards climate change mitigation are extremely commendable, there is still considerable scope for improvement. India needs to develop energy efficiency in production and address inequalities in carbon footprints across different sections of the population. Now, the study also highlights that neither India nor Italy achieved a perfect score of 1 on the Climate Performance Index, which indicates that all G20 members have certain strengths that could be leveraged and weaknesses that need to be addressed while envisioning a broader strategy of national climate action, catering to specific climate goals and targets. Overall, India's progress towards climate change mitigation is an excellent example of how a developing country can take significant steps towards building a more sustainable future while contributing to global efforts to combat climate change. What are the measures taken by the Indian economy? Now, as India continues to make progress towards mitigating climate change, it is heartening to see that the government is taking concrete steps to support the transition towards a greener economy. The introduction of the battery swapping policy and digitally enabled single window green clearances are particularly noteworthy as they aim to make it easier for businesses to adopt sustainable practices. Moreover, the plan to issue sovereign green bonds is a significant step towards mobilizing private investment in green infrastructure and addressing the funding gap required for meeting India's climate goals. This move puts India in the league of countries like Germany, France, and Sweden that have already issued sovereign green bonds. Now, as the report highlights, there's still a long way to go. Inequalities in carbon footprints across different sections of the population need to be addressed, and more efforts are required to promote energy efficiency in production. Nonetheless, India's ranking as a top G20 country in terms of climate performance is a testament to the progress made so far and the country's commitment to leading the way towards a sustainable future. Imagine being able to trade in the Indian equity markets till 5 p.m. and derivatives till 11:55 p.m., giving you more time to buy and sell stocks. That's exactly what NSE CEO is advocating for, extending the trading hours in India's equity markets. Currently, the market is active for only 6 hours and 15 minutes from 9:15 a.m. to 5:30 p.m. and compared to other global markets, this seems to be a tad bit on the lower side. Having said that, the idea of extended trading hours is not new to India. In fact, SEBI had allowed exchanges to extend trading hours way back in 2010, but it was never implemented. Now, with the market regulator and the exchanges considering the idea again, it remains to be seen if the extended hours will be implemented this time around. If we were to compare India's trading hours with other global markets, the London and Frankfurt Stock Exchange remain the clear winners with an active trading hours of 8.5 hours, followed by NYSE, which is the New York Stock Exchange, with 6 hours and 30 minutes of trading. The Shanghai Composite Index and the Tokyo Stock Exchange have active trading hours of about 4 hours and 5 hours respectively. Now, what are the advantages of extending the trading hours, you may ask? Let's dive deeper into the advantages of extending trading hours in the Indian stock market. Firstly, longer trading hours will allow investors and traders to better manage their overnight risk. In a world where almost all economies are interconnected, any significant event of news in one country can have a ripple effect on all the other countries. Limited trading hours don't allow participants to hedge their risks due to the global information flow, which can lead to significant price fluctuations when the markets open. Now, longer trading hours would provide more time for investors to react to the global news and minimize their overnight risk. Secondly, SEBI suggests that the extension of market hours will help make Indian markets more efficient. By allowing investors and traders to effectively absorb information around the clock, the Indian stock market can become more reactive and efficient in its pricing. Third, the early and the long active hours of the SGX Nifty, which is a derivative of the Nifty index traded on the Singapore Stock Exchange, currently attracts a lot of business from India. With longer trading hours, Indian investors and traders can better compare with the convenience and accessibility of SGX Nifty and keep more business within the Indian stock market. Overall, extending the trading hours in the Indian stock market could lead to increased volumes, reduced overnight market risk, more opportunities for traders to hedge positions, increased liquidity, and the attraction of more participants, including mutual funds and foreign institutional investors. Having talked about the advantages, the extension of the trading hours in the Indian markets may also have some disadvantages. One major concern is the impact it could have on the work-life balance of traders and other market participants. Longer hours mean that individuals will have to spend more time monitoring market movements and responding to changes, which could lead to increased stress and burnout. Another disadvantage is the potential impact on the small and medium-sized brokers who may not have the resources to keep up with the increased workload, and they may struggle to compete with larger firms who have the financial resources to invest in technology and infrastructure. Moreover, there is a risk that extended trading hours could lead to increased volatility in the markets. With more time to react to news and events, traders may overreact and make hasty decisions that could lead to sudden price swings. This could also lead to increased speculation, which is not necessarily a positive development for the market as a whole. Last, there could be an impact on the broader economy. Longer trading hours could lead to higher levels of speculation, which may result in bubbles forming in certain sectors. This could lead to misallocation of resources and an eventual correction, which could harm the overall economy. Overall, while there are some potential advantages to extending the trading hours, it is important to consider the potential drawbacks and ensure that any changes made to the market are carefully considered and implemented in a way that benefits all the stakeholders. Now, it seems like the WhatsApp Academy has turned everyone into fortune tellers. They're all waiting for the market to bottom out like it's a limbo contest. Inflation is like a villain in a Bollywood movie. Everyone's waiting for it to reach its peak so it can finally retire to the mountains. And the interest rates, well, they are stubborn neighbors who won't budge no matter how much you plead with them. Over coffee or lunch, people are discussing the markets like they're talking about the latest episode of a reality show. Did you hear about the demat accounts? They're dropping like flies. It's like they're counting the casualties of a war. And then there's the video that shows how the markets have been less rewarding than bank deposits. It's like comparing apples to oranges. One is a fruit, of course, and the other is a place to keep your money. But who cares about logic here, right? When you have WhatsApp forwards to believe in, rumors of the RBI raising interest rates are like a dark cloud hanging over everyone's heads. It's like waiting for the school principal to announce the results for an exam you never studied for. But hey, don't forget that the Indian markets have seen their glory days, and now it's all gloom and doom. It's like the markets are stuck in a time warp and the rest of the world is moving on without them. So let's sit back, sip our coffee or tea, and wait for the WhatsApp forwards to tell us what next to do. Who needs financial advisors when you have a bunch of unverified messages on your phone, right? Well, at least that's what naive investors are doing as they are worried about what's to come in FY24. However, we feel it's time to stop listening to the gossip mill and start focusing on the facts. And we are here to help you cut through the noise and help you understand what's really happening in the markets. Yes, the markets have been playing cat and mouse with us for a while now. 3% up, 3% down, but that's just a prelude to the big show. It's time to put on your dancing shoes, and because the uptrend is just around the corner. And I don't mean a tiny uptick. It's a full-blown party that's coming your way. So don't get stuck in this consolidation zone. Yes, the interest rates have been creeping up, and it's no fun paying more for our loans. But let's not panic just yet. The RBI knows that what it's doing, and they've got our backs. They're not going to raise interest rates endlessly, and they've already hinted that the inflation will peak soon. So you need to hang in there and keep calm. Yes, the demat accounts may not be growing as fast as last year, but that's just because reality has set in. Those fresh investors from 2020 were just spoiled by the high returns they experienced. It's time to have a more level-headed approach to investing and focus on long-term gains. There are no shortcuts to success, and you need to put that hard work to reap the rewards. Patience is the key, and your investments will grow steadily over time. The Indian markets are about to burst with potential, and even the policymakers and the market gurus agree to that. Let me present the facts. 1. The earnings look better than a plate of hot samosas, and the growth levers announced in the recent budget are like a box of assorted sweets. A dream come true. Deepak Bagla, the MD and CEO of Invest India, in his Treasure Leadership Forum 2023 keynote address, dropped some serious knowledge bombs. Since independence, India has seen $950 billion in FDI, of which $532 billion has come in the last 90 months alone from 162 countries. This is a global record. That's more money than any Bollywood blockbuster. Now, the first $1 trillion for India's economic growth took 67 years. The second trillion took 8 years. And the third trillion took just 5 years to deliver. Can you believe the pace at which India is growing currently? And that's just not it, because India is on a wild ride to the top. In the past 9 years, India has moved past Russia, Italy, Brazil, France, UK, and a number 10 economy in GDP terms to the 5th largest economy globally. India may likely surpass Germany's position to become the 4th largest economy in GDP terms in a few years. Most of the growth in GDP is through domestic demand. That's how powerful the growth story has been and will likely continue further. Of the 1.4 billion human resource potential, India has nearly a billion aged under 35. The average age in India is 29, and it will remain the youngest human talent pool till 2070. The size of this growing affluent Indian population is creating a market that the world can't really get over. The Honorable Prime Minister Narendra Modi ji launched Digital India 100 months ago, and India was ranked 123 in terms of per capita data consumption. 100 months forward, it is now ranked number 1 in the per capita data consumption today. In India, 41% of the world's real-time digital transactions happened in 2021. India did 48 billion transactions and China had just 18 billion transactions. In October 2022 alone, India had 8.4 billion transactions in real time. In 84 months since its launch, Startup India ranked number 3 worldwide for startups, and in 2021, India added 44 unicorns and 21 in 2022. India has the second largest population on the internet today. Every second, 3 new people join the internet in India. 2 out of 3 people are from the villages. Now, if you listen to the WhatsApp Academy's stock market predictions, you might as well be watching a Bollywood movie on mute while reading Shakespeare's sonnets. Sure, there may be some technicalities involved like range-bound markets and rising interest rates, but why focus on that when the entire world is turning their head towards the unstoppable force that is India? Let's not miss the bigger picture. What if the Nifty at 17,500 or 18,000 levels are a thing of the past from here on? It's time to break free from the WhatsApp echo chamber and embrace your inner greediness. Let's ride the India juggernaut to the moon and beyond. With this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.